Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor. Really pleased to have with me once again Lyn Alden. And I would just suggest that you go to lynalden.com to check out all that she does. She is very generous with her work. She shares a newsletter. It's not quite every month, but almost every other month or every 6 weeks or something like that. It's just always a must-read. When I see it coming in my inbox, I read it, and that is a freebie. But she does also have a very reasonably priced service for people who would like to invest based on her insights, and she's been very, very successful. And I think evidence of that is her growing popularity. I was very pleased recently to be having lunch with my wife and watching Charles Payne on Fox Business, and there she was. Really nice to see Lyn getting the attention she deserves. And as I say, it's because I think her insights are unique to Lyn, and she provides a lot of value to people. So that's why you should go to lynalden.com. Consider signing up for her letter, either the freebie or maybe you want to consider paying this lady for the good work she does. Lyn, thanks for joining us again.
Thanks for having me back. Always happy to be here.
Oh, thank you. It's really great to hear you say that. You started out, and I'd like to refer to the January 16th, 2022 newsletter titled The Capital Sponge. You started out noting that the U.S. stock market, recently totaled, I think, 61.3% of all global market capitalization, despite the fact that the U.S. GDP is only 23% of the global GDP. Maybe we can get into what are the reasons. How did so much money flow into the U.S. equity markets? And you provided a number of reasons. I'd like to maybe just go there right away. Reason number one was lower rates. Could you talk about how that impacted and how that sucked capital into the U.S.?
Yeah, so this variable was true for all of the developed world, which is essentially that all these different countries cut their rates from pretty high levels back in the 80s, steadily down for decades to zero or even below zero in some cases. And so that translated a different, basically when you have a much lower interest rate, when you're comparing investing in stocks and determining what valuation is appropriate, you're comparing it to a lower and lower hurdle rate. So, for example, if treasuries pay you 5%, then you might demand 10% returns on your more volatile equities. But if treasuries are yielding 1 or 2%, you might settle for 5 or 6% on your equities. And so, as we've squeezed the yields out of bonds worldwide and cash, it's propped up assets. And so, in places like Europe, Canada, Australia, China, a lot of that goes into their real estate markets. In the United States, because we have the deepest and most liquid stock market, and because interest rates particularly benefit growth stocks, and the S&P 500, the American stock market, very growth-oriented, high technology exposure, a lot of the capital poured over into U.S. markets. And so our real estate market is not necessarily as elevated as some of those really bubbly real estate markets out there, but instead our equity market captured quite a bit. And a lot of people assume that even though the United States is a decreasing share of global GDP compared to our market cap, they assume that maybe it's because we're selling so many products abroad. Like maybe we're selling so many iPhones. But actually, if you look at, say, the S&P 500% of foreign sales, it's flat to down over the past decade. And so it's not that we're selling more to the rest of the world. Quite the contrary. We have a massive trade deficit. Instead, it's really about that, corporations have been able to increase their profit margins because they've been able to offshore their labor outside of the country. They've been given tax cuts that help boost their valuation. And they have much higher earnings multiples on top of those elevated earnings. And so it's mostly about that domestic focus and the high valuations that have propelled so much U.S. stock market performance and have resulted in so much capital being stuffed into U.S. markets.
So I'm still not sure that I understand why, let's say, Canada has higher, I think you said the Canadians have higher real estate prices, or that housing isn't necessarily, compared to some of these other countries, we think of it, especially living in New York and San Francisco and places like that, they're very expensive. But I guess overall the U.S. real estate markets are not as stretched as some of the others, then, I guess I hear you saying.
Yeah, generally, if you look at, for example, China has a very, very rich housing market, and some of those buyers then go to Australia and Canada in particular. and other in parts of Southeast Asia, and they pour capital into those markets. They invest heavily in real estate. Whereas, for example, pension funds around the world, sovereign wealth funds around the world, they want more liquid type of securities, and so the biggest, deepest liquid market in the world is basically the U.S. stock market. And so a lot of that capital pours over. And if you look at U.S. value stocks, they're not necessarily very highly valued. Like if you look at our banks, if you look at our healthcare companies, if you look at our energy companies, they're not, they're somewhat more expensive than the rest of the world. But really, it's the growth equities, and just the U.S. stock market happens to have a much higher allocation to technology and consumer discretionary. And so a lot of this capital, when they say, okay, so interest rates are super low, and they say, I want something with structural growth. And so they pour into growth stocks that make sense, except that now they're bid up to such high valuations that it becomes riskier.
Right. Well, I mean, some of those giants like Google and some of those guys, Facebook and Twitter, and some of those, I guess, are doing extremely well. But you think there's some risk with some of those big guys as well?
Yeah, but if you look at over the past decade, for example, they've done very well fundamentally, but then their valuations went up even faster. And so, for example, as they get bigger and as their growth in many cases decelerates, their valuations are actually higher than they used to be. Whereas, as you transition from a growth stock to more of a blue chip value stock, you'd expect valuations to come down eventually to reflect that. And instead, many of them are at rather high valuations. And it's not just the tech sectors. It's basically any sort of like growth, low volatility equity, like things like Costco, Nike, for example. Their multiples are quite high. And if you look at U.S. household equity allocations, they're near the highest they've ever been. So basically, U.S. households have a greater share of their net worth in equities than pretty much any other time over the past 70 years. Americans are underweight foreign securities and overweight domestic securities, and then the rest of the world is also overweight U.S. securities. And so we have to ask ourselves at this point, who's the marginal buyer? Who's going to come in and keep getting us even higher in terms of valuation? That doesn't mean we're necessarily calling a top, but it means that there's more. The higher you get, gravity becomes so much stronger here in terms of pulling down and making it hard to keep increasing valuations.
Yeah, you have to wonder then. Well, maybe we'll get to the reasons or the catalysts that could change things. So, and I certainly want to hear that. I hear you talk about that. But corporate tax rates. I mean, when I turn on Fox and I listen to people, the Republicans, they're complaining that our tax rates are too high. But I guess what you're talking about are effective tax rates. There's always these loopholes that are there. I mean, any comment on that? Taxes, I think you made the point in your article that one of the reasons so much capital has flown here is that the policies have been weighted towards corporate interests in the last couple of decades, right?
Yeah, so there's different ways to characterize tax. And so if you specifically look at corporate tax rate, which is basically saying, okay, here's your corporate income, we're going to take a percentage of it. One is that the effective rate is much lower than the headline rate because of various deductions, loopholes, things like that. That's gone steadily down. I have a chart on it basically just showing like a steady decline to pretty low levels. And I'm in favor of low corporate tax rates, but we have to acknowledge that as that's gone down, it's been a factor in pushing up equity multiples. And then specifically also basically there's different ways to tax different segments of society. And so as we've decreased our emphasis on corporate tax, we've increased our emphasis on payroll taxes. And so basically you tax consumers more on their paycheck side. And in addition, that's also got an employer side. So employers pay payroll taxes. And what that essentially means is that if you look at the biggest companies like Apple, Microsoft, Netflix, companies like that, labor costs are a much smaller share of their revenue. And so when you have a high payroll tax and a low net income tax, that benefits those capital light companies, those software type of companies, financials. Whereas if you instead, for example, focus your tax cuts on maybe the employer side of payroll tax, then that would actually benefit the manufacturers. That would benefit the domestic, more heavy asset type of industries. And so how they tweak tax policy has a big impact on which industries benefit. And because that headline and effective rate's gone down, it's helped propel capital into those software type names.
Okay, so a third reason that you gave for the massive flow of capital to the U.S. was recycled trade deficits. Can you explain how America's chronic trade deficit, which we've had, I guess, going back pretty much since 1971 is when it started and went off the gold standard, how has that fueled money going into the U.S.? I guess it's just that foreigners have more dollars, and so they recycle them here, either into treasuries or equity markets.
Yeah, so back in 1974, after the U.S. was trying to salvage the system, and what they did is they made a deal with Saudi Arabia and other OPEC nations, and they said, look, we have this really big military, we're a really big trade partner, and they say, okay, you go ahead, Saudi Arabia, and you only sell your oil in dollars, no matter who's buying it. France, Japan, doesn't matter. If they want your oil, only agree to sell in dollars, and in exchange, we'll give you good trade deals like arms. We'll also protect the region for you and ensure stability. And so now, for almost 50 years, the vast majority of oil sales globally are priced in dollars. And what that essentially means is that any country in the world that wants to import oil needs to have dollars. And so it creates this extra demand for dollars. And that sounds good at first, except that basically it strengthens the dollar above what it would be on a trade-weighted basis. So it makes our importing power more competitive, and it makes our exports less competitive because they're basically more expensive compared to, say, not just their emerging market peers, but compared to the European and Japanese peers as well. And so that basically makes it much more costly, much more challenging to make things and export physical things from the United States. We can still do high margin things like software and finance and healthcare and things like that, but only that there's a headwind against anyone that wants to make physical things in the United States. And so it's contributed to this kind of structural trade deficit, and all those dollars flow out to those creditor countries, those countries running big trade surpluses. So China, Germany, Japan, Taiwan, Switzerland, they take these all their dollars, and then they used to buy treasuries. They still do to some extent, but they also buy U.S. stocks. They buy U.S. real estate. They buy U.S. land. They buy wholly owned U.S. subsidiaries, companies. And so they end up, we basically we're running a deficit. We're buying consumer products, depreciating consumer products from overseas, and they take those dollars and they buy our permanent appreciating hard assets with them over time. So we're basically hollowing out our financial base to consume.
We're hollowing out our manufacturing base, are we not? If the money flows overseas to the creditor nations, then they're in a position where they can buy essential assets. Is that what's happening to a certain extent? And then we're losing our manufacturing jobs as well?
Yeah, and it's a 1-2 punch, because if you go back to the prior point, so we do cut corporate taxes, but our payroll taxes are still high, and we have the highest healthcare cost per capita, which is a big chunk of that is on employers, and so it's very hard to basically hire Americans for manufacturing work, even not just compared to emerging markets, but compared to industrial advanced peers. It's fine to say export low margin things like textiles, but you don't want to be in the position of not being able to produce high quality machinery, for example. And so we've been in that situation. And so if you're in the top 10% of the population that owns 89% of U.S. equities, you benefit. Your job did not really get outsourced. Your capital assets keep going up in price. But if you're generally in say the other 90%, especially the blue collar physical workforce, you generally got a lot of the cost of the system, and you didn't necessarily own a lot of the assets that ballooned in price over these decades.
Well, I thought it was really interesting when you said that Kissinger, I guess the Nixon administration, went to Saudi Arabia and said, "Look, we have this big military, we have all these armaments, and let's get some use out of them, right? Let's use these things." And I just have to keep thinking back. I'm an old guy, a lot older than you, Lyn, and I remember hearing about President Eisenhower warning about the military-industrial complex, and it seems to me that this whole idea of the dollar making the dollar into a petrodollar instead of a gold-backed dollar allowed the United States to expand its empire much more aggressively than it would have if there was more of an even playing field with a gold monetary system as we had up until 71. Any thoughts on that?
Yeah, and it came at a cost. So basically, you can argue, like analyst Luke Roman has argued, that, say, in the 1970s and 80s, the system kind of made sense. It was kind of a chess move against the Soviet Union in the Middle East to make sure we had control of that region. But ever since the Soviet Union fell in the 90s, we probably should have pivoted the system but instead by maintaining the petrodollar system as it is, the United States has been tied at the hip with Saudi Arabia, right? So it's not exactly the most humanitarian partner to have in this arrangement, to say the least. And so we're tied at the hip with Saudi Arabia, and we have to, look the other way in a lot of their policies, and kind of basically what we do is we sacrifice kind of domestic vibrancy. We outsource our manufacturing base. We have the highest wealth concentration in the developed world, in large part because these policies are not really great for our blue-collar workers, and we kind of put all the benefits onto the capital holders. And so it's been this environment where capitalism gets blamed for a lot of things, but really it's that cronyism, it's that military-industrial complex, and so I think it's the exact issue that Eisenhower warned about.
Yeah, I definitely do. It seems very clear to me. Well, interesting also, and I know I'm spending more time on the reason number 3, the recycled trade deficit, because it seems so much a part of the system. But I just was wondering also, an interesting part in your letter, the Dutch disease. The Financial Times called the petrodollar the Dutch disease. Maybe you could just explain what the Dutch disease is and how it sort of fits with what's going on here in the U.S.
Well, yeah, basically what it refers to is, like, let's say I make machinery, and let's say you're in Europe and you make machinery, right? So we're competing against each other, and then someone in my country finds an absolutely massive oil field, and they start exporting a lot of oil, and that strengthens the currency that I'm operating in, right? That now suddenly my products are less competitive on the international scale than your products, and so I could cut prices in my currency, but the problem is, my employees are paid in my currency, my debt is denominated in my currency, and so I just overall become less competitive of a business than you because of this other oil find. It'd be different. It'd be different if we were pricing our products in, say, grams of gold, some sort of international standard. But because we're pricing it in our currencies, and our currencies can be impacted by something else. So basically, what that article refers to is that by putting the Treasury at the center of the global system and basically enforcing its usage, United States basically gave itself Dutch disease because everybody in the world needs dollars and treasuries. And that essentially, it basically makes our exports less competitive. It makes our imports stronger. And so it kind of gives us this structural trade deficit. And so depending on where you are in that system, if you're a foreign exporter, you're benefiting. If you're an American kind of, top 10% capital holder, you're benefiting. But if you're a foreign consumer, or if you're a domestic manufacturer, you're impacted negatively by that system. And so it's basically the system kind of has advantages and disadvantages, but it really does pick winners.
All right. Lyn, we only have a few minutes left, and I'm going to just mention reason number 4 is passive investing. I guess that has to do with money going into the large capital companies for the most part.
Yeah, when you have a market cap weighted index and you put more money in, basically you keep instructing the passive index provider to keep buying more and more of those large companies. And so, that creates, people complain about that. It does create opportunities for investors that are willing to go around the side and find these other events that are being overlooked. But it also does, kind of drive up these valuations, especially for the more growth and large market cap indices. And the risk is that if all this capital gets shoved in, if there's changing conditions, if the Fed tries to withdraw liquidity, if basically we get past Omicron, the world opens up more, capital can move out of the country, and you can get a declining dollar and a declining stock market at the same time. And that's actually, if you look at the dot-com bubble, again, so much capital was shoved in there, and the dollar was very strong, and you had the Asian financial crisis, and long-term capital management blew up in part because that dollar was spiking and causing those emerging markets to run into issues. But as that eventually unwound after the dot-com bubble, you had U.S. equity markets and the U.S. dollar being weak together. And so we potentially could go through another one of those cycles.
Right. All right. Well, let's get to the catalyst with a couple of minutes left here. The catalyst that could lead a reversal of this capital flow to the United States equity markets. Interest rates.
Yeah, so
I guess that's an obvious one.
Yeah, we've been in this 40-year structural downtrend of interest rates, and they wouldn't even have to go up in order to cause headwinds here. If they just start going sideways, if they kind of run into this kind of near zero level and they start chopping sideways, that already takes out one of the tailwinds. Another one is that there have been talks about potentially raising corporate tax rates a little bit. At the very least, it seems like there's not another corporate tax cut on the horizon. And so that kind of trend of structurally lower corporate tax rates is probably behind us. We've also, U.S. corporations have benefited from an aggressive kind of 25-year policy of outsourcing, where they've been able to they basically do geographic arbitrage. They save on wages while still earning high revenue. And China's kind of past its peak in terms of population growth, in terms of its ability to harness a lot of power for manufacturing. And so I think we're part of the supply chain problems we're seeing is that we've kind of already tapped into that big deflationary resource of new labor. And so I think some of those trends are going to be a little bit harder for corporations to maintain their profit margins. And then also, basically we saw, for example, last year China cracked down on its tech sector pretty hard. Yeah. And we see in the United States, I mean, there are members of both major parties that have an interest in antitrust activities, maybe not to the extreme degree that China did, but that they have an interest in going after some of these large companies that they feel have monopoly-like characteristics. And so if you start to see a pressure there, that could be interesting. And I think also the last point is that going back to that inflation question, commodity capex is a lot tighter now. And so if you get that inflation, that kind of more persistent type of inflation from a high commodity environment, that can put upward pressure on interest rates. It can put downward pressure on some of these valuations of these really kind of high valued growth oriented software type companies.
And are you expecting that, Lyn? Are you expecting more inflation?
So I think we're probably looking at a temporary deceleration of inflation, but I do think that the 2020s in general are likely to be more inflationary on average than the 2010s, which is generally not the best environment for those really growth-oriented, high-value companies.
All right, we're going to have to leave it go at that. My engineer tells me I'm out of time. Thank you so much, Lyn, and once again for being with us. Always a pleasure having you. Your insights are very much appreciated, and we'll hope to do it again sometime soon.